In this episode, the topic we will be touching upon has little to do with business or macroeconomics, but we chose this topic because it touches all our lives. Ours, yours, maybe your parents, and if you're young enough, even your grandparents. We try and answer this question: how much do you need to help fund your living expenses after retirement? Hello and welcome back to Business Matters at the Hindu with me, K. Bharat Kumar. If you're not a government servant assured of pension on retirement, you're probably saving up during your working years, investing in the stock markets, in fixed deposits, a roof above your head, maybe even gold, and so on. So the idea is to have a corpus at the point in time when you retire and start withdrawing from that corpus over the years during your retirement period till end of life. Now, globally, the rate at which you can withdraw from that corpus and still have a meaningful amount left over every year till end of your life is accepted at 4%. That is, you start withdrawing at the rate of 4% in the first year after your retirement and slowly increase that percentage because your expenses will still keep going up. But hopefully the returns from the residual part of that corpus will make sure that you have a respectable amount left over each year. But the question is that 4% applicable in the India context? Because after all, the Indian context is very different. The stock markets are volatile, inflation rates are much higher here than in the West, and so on. A recent research paper by Rajan Raju and Ravi Sarogi has shown how the global standard can't be used in the India context. Their research concludes that even a withdrawal rate of 3.5% for an Indian citizen is bound to fail over 35 years. And obviously, they warn that if your portfolio of savings includes too much investment in equity, it could potentially give you healthy returns, but Indian markets are so volatile that you could also end up losing capital. And if you're heavily dependent on fixed deposits, then the returns could be too low given the tax implications and the effect of relatively high inflation. So the authors of the paper suggest that a rate anywhere between 3 and 3.5% is a good rate at which to start withdrawing from your corpus. And they say they'd probably be nearer or have it nearer than 3% just to be on the conservative side. They also point out that bringing in gold into your portfolio may actually help you instead of just confining yourself to just equities and debt such as fixed deposits. So they say about 10% of your corpus should be invested in gold. So when there is vagaries of the stock market, they go up and down, and when it really plummets, then the value of gold helps retain the value of your entire corpus. So if the 10% of your corpus is actually dedicated to gold, where does that 10% come from? It comes from equities. They say let fixed deposits remain at 60% as historically advised, equities 30% and gold 10%. The authors also suggest that you start withdrawing from this corpus at lower rates in the early years of your retirement and bump that rate up as you age, because later your expenses may be higher, example, medical expenses, than when you're just above 60, hopefully. Our internal expert on investment advice, Aarthi, Krishnan, who is consulting editor with Businessline, has written an article. The URL for this article will accompany the text alongside this video. In this piece, she's taken the example of a 25-year-old lady. The lady estimates that her current monthly expenses are 50,000 rupees, or about 6 lakhs rupees a year. In 35 years' time, assuming a 6% inflation rate, the same expenses would cost her about 46.1 lakh rupees a year by the time that lady is age 60. Which means the corpus that lady would need at age 60 is about 15.4 crore approximately. That is about 33 times the expenses estimated at age 60. So what are the calculations behind this figure? We spoke to Ms. Krishnan, and this is what she had to say. Hello Aarthi, welcome to Business Matters. Thank you for sparing time to be with us today. This concept of withdrawal in the context of retirement is a new terminology for several of us. So could you please help our viewers understand what this means here?
Calculating a retirement corpus is quite a complicated exercise. So, usually when people say the size of the corpus that they need to retire in India, they get quite shocked because it runs into double-digit crores for most categories of people. And this calculation actually entails estimating what is your current likely level of expenses. For example, I've mentioned that example of the 25-year-old called Suja in that article. Suppose she thinks that she's currently earning about 75K a month, and she thinks that at retirement she can get by at, say, 50K a month. So the first step is actually converting that 50K into an annual number, which is 6 lakh a year, and then adjusting that for inflation over the rest of her working life. So that is how the 6 lakh a year actually becomes 46 lakh by the time she is 60. So this withdrawal rate or safe withdrawal rate is a retirement concept which talks about how much you can safely withdraw from the fund that you built up in the first year of retirement so that it lasts throughout your life and you don't outlive it. So the safe withdrawal rate is the amount that you can withdraw from the money that you built up in the first year of retirement. That is, if you're 60 and you're retiring at 60, what you can withdraw that very first year is the safe withdrawal rate. Why I'm emphasizing this first year here is that withdrawal will keep going up over the rest of your life, right? Because of inflation, that what you withdraw in the first year will be slightly more in the second year and so on and so forth. So the withdrawal rate of 4% applies only to the first year of retirement.
When you put up your piece on Twitter, there were some interesting comments in the reply section. Someone asked, I already have a corpus of 6 to 7 crore. What if I put it up in FDs and start withdrawing interest of 6 to 7%? Wouldn't that be enough to carry on? What is your view on such questions?
So let's talk about the FD part first. Suppose I put it in an FD earning 7%, about 7 crore. Yes, in the first year, you can withdraw 46 lakhs. But the problem is every year you will be able to withdraw only 46 lakh because the 7% is the return that you're likely to get. And in fact, in the long run, that interest rate can fall, rise. So it is not a given that it will be fixed. But suppose, let's assume for simplicity that actually you are able to withdraw 46 lakh continuously. The problem is that with inflation in your living expenses, the 46 lakh that you have at 60 years of age will no longer be enough for you by the time you're 70, because again, inflation would have made it into a much bigger number. So the problem is after retirement, you have to withdraw increasing sums from your corpus. And the FD will not actually allow you to do that because you will have to basically draw from your capital over time. Now coming to equities, today many people, because the bull market has been in progress for the last 8 or 9 years with very few corrections, many people think equities can give you 12% or 13%. So why should you even worry about it? Just put your entire retirement corpus into equities and then you'll be happy. But the problem is with the equities, you can have very big corrections, right? We have seen corrections in 2008, which took down the Sensex by over 50%, and one later also in 2011, which took it down by over 20%. So suppose in the first year of retirement, when you have this big corpus built up, you put it all in equities and the market tanks by say 25%, you will immediately lose 25% of the money that you worked so hard to actually collect in the very first year. If this happens in the initial years of your retirement, the corpus that you have left for the rest of your retired life will be much lower. And then there is a doubt about whether you can meet your goals. This is why the authors in that paper actually argue for a kind of a balanced portfolio. We have with debt, equities, and a bit of gold actually to smooth out these falls.
It's interesting the authors of that paper talk about gold. In our own internal conversations, you've not been a great fan of investments in real estate for the sake of returns, or I haven't heard you talk too much about gold either. What are your views in this context?
Real estate, I think I have no objection to it, but the problem is it's an illiquid kind of an asset. So when you really need the money, you're unable to sell the plot of land or the house. Even if it has appreciated very handsomely, you're unable to actually sell it and raise cash. That is the thing that I've personally also experienced. In the retirement portfolio, I think the reason they don't put it is also the same. That is, it is not a liquid asset. So this concept of withdrawing every year, you certainly cannot practice with real estate. If at all you need to have real estate after retirement, it should be for your own living so that you can save on the rental expenses, which can also be a big chunk of your expenses actually. So it does make sense to have an owned house which is self-occupied after retirement. So you can plan for that during your time. Now coming to gold, gold is unlike equities or bonds where there are underlying cash flows that come to you as an investor. In gold, there is no cash flow. So your entire return depends on the movement in gold prices over a long period. So if you look back at history, actually, gold has tended to offer returns that are in the extremes. There are periods when it goes up 20% every year for 4 5 years. There are periods when it barely gets you to a savings bank account return of 4%. So it is almost half between these two. So sometimes it gives you 20% plus, sometimes it gives you 4%. So having it as a mainstay of your portfolio is not a very good idea because of this return volatility. And gold generally offers very good returns when there's a global crisis, typically like the global housing crisis that we saw, subprime or something like that happening, or a war or geopolitical thing, brief flare up in gold prices happen. So the thing is, you can never predict when a crisis will happen. By its very definition, it will happen suddenly, and then gold goes up. So the only way to actually invest in gold is to hold a constant allocation to it in your portfolio of say 5-10%. And then what happens is when a crisis happens, stocks fall very sharply. At that time, the gold goes up and sort of provides a sort of counterbalance to your portfolio and cushions it. Which is why actually gold in your retirement portfolio also, what it will do mainly is to cushion any fall in stock markets which reduce your portfolio value. So, which is why the authors have also said you have some gold allocation.
How do we estimate how long we live? Because obviously we'd love to live till 90 or 100 healthy years, but it's a difficult estimation, and it interferes with the way we make our calculations and so on. And one comment in that Twitter thread of yours actually said that the average age for an Indian citizen is about 72 years. So why are you assuming 90? Isn't that being over-conservative and all that? Your view?
So there are 2 or 3 counters. See, longevity is, of course, a very personal thing. I mean, there are some families which by heredity itself, the longevity is high. There are some where longevity is low. So definitely genetics and hereditary factors contribute to your longevity. Now, talking of this average longevity business, like the 72 years is basically the average longevity at birth. So when a person is born today, this is the longevity. But the problem is, if you've already lived till 60 or something, your longevity tends to be a bit higher. A second point is that if you're in a more affluent part of society, which is where if you're on Twitter and if you're talking about retirement planning, you're among the top, definitely among the top 25-30% of Indians. So given you better nutrition, income levels, etc., definitely your longevity will be higher than what is the average. It's like in India, the per capita income is 1.5 lakh a year. Okay. So what is your income? I mean, so it is far higher, right? So you have to realize that your longevity also can be higher. Now, of course, the 90 may be a very conservative thing. You may like to budget for 85, 80, etc. But in financial planning, it is always better to like overestimate your longevity because you don't want to outlive your money, right? So from a financial planning perspective, it is always better to take stretch a greater number in terms of longevity so that you are over budgeting and not under budget. The other point is that many people do want to leave a legacy for their children, right? So if you plan it so exactly and say that I will live only till 75 and budget for it, you may outlive your corpus and you may also end up depending on your children and not leaving them anything when you actually, when your time comes. So that's not something you want to risk, right? That is why the longevity of 90 years is has been taken. Of course, that you can take a lower longevity, and that paper also has calculations for 85-year longevity. In
your article, you talk about an average of 12% returns on equity investments to help this young lady achieve her corpus target by the time she's age 60. 12% to be done consistently over a 35-year period. Is that even feasible? Because there are times when the stock market plummets, and I do not know if in the years that it does so well, that it makes up for all these negative rates of return.
Every year equities won't deliver 12%. But since I'm putting this equity calculation only for the pre-retirement period, so what I'm saying is, if Suja invests in equities for building up a retirement corpus from the age of 25, then I'm assuming a 12% return on the equity. Now, equity will definitely deliver minus 30 in 1 year and plus 100 in another year and so on. So that will average out to 12% over time. I think that is a fair assumption because If you look at the equity CAGR, even on the Nifty and Sensex over the last 20 years, this 12 to 13% is what the market has managed. So that is how I've actually arrived at that kind of an assumption. And also, if India is going to grow at say 7% as an economy with 5% inflation, we can assume that company earnings will grow at 12%, and that is also another way to basically validate the 12% assumption on equities.
Is it over pessimistic to assume a 6% rate of inflation over such a long period? After all, if India, as the authorities claim, is inching its way towards becoming a developed nation or closer to the rate of growth of developed nations, then inflation rates must also be managed to roll much lower, maybe 2%, 1.5% over the years. What is your view there?
Yes, I'm just being conservative and going by history. And again, if you take very long-term averages in CPI, it's about 6%. So that's why I've taken that assumption. But yes, in future, actually, if India becomes a developed upon economy, there's a possibility that inflation will fall and so will interest rates. The problem is that what you are trying to generate here is real returns. So returns over and above inflation. So if inflation falls to 2-3%, I think even bond yields will fall to, say, government bond yields may fall to again 3-4%. Again, your real return equation will remain the same. So that doesn't really, and the equity return will then be bond return plus 5%, which may be 9%, right? So I think it is the real returns which matter. So the absolute number inflation thing it's just used for illustration. The other point is that if you see the MPC's target, which is the Monetary Policy Committee in India, is tasked with containing inflation within a band of 2 to 6%. So I feel that they will be successful at it. That's why I've taken the 6% upper limit as the sort of the assumption.
So the final question is to do with macro policy. You do dwell on this in your article, but if you have to elaborate further, what exactly must the government be doing? Because it has the problem of collections, the revenues that it makes from direct and indirect taxes. But at the same time, you do not want to disincentivize senior citizens who peg all their hopes mostly on fixed deposits. And if the rate of return is so low and it is taxed, it leads to other problems. What do you suggest the government does?
So I think the main takeaway from this paper is that Indians may need a substantial portion of equity to save for retirement, because the corpus requirements are so huge that you cannot do it with just debt-oriented vehicles. Today, if you see, the default retirement vehicle that most people use is the Employees Provident Fund or the Public Provident Fund, PPF. These give returns of 7% and 8%, and they're tax-free, thankfully. But the 7%, 8% really does not get you to your target. So I feel it is necessary for the default vehicle itself to be the NPS or some retirement equity funds, etc. Like in the US, you have this 401k plan, right? So I feel that you need an equity-oriented vehicle to be a default vehicle, and EPF, PPF should be basically a part of your allocation, but not the entire. So that is the first thing. Perhaps the tax laws and even the laws relating to establishments offering compulsory EPF, etc., need to be relooked at. Secondly, I feel that this removal of indexation benefits across financial products. I mean, in debt, they removed indexation benefits a year ago, and equity never enjoyed any indexation, and it has been made taxable at a flat capital gains tax rate. So I think giving this inflation indexation will at least allow people to earn a real return on their financial investments in the long run. So perhaps government can sort of make it very selective by saying that if you hold a certain instrument over 10 years, then you can enjoy indexation or something like that. That way the outgo for the fisc also won't be too. I think the third thing is, after retirement, whatever savings you have, that income, interest income, etc., should not be taxed very steeply. So perhaps the retirees' tax slabs, which are already slightly higher than the normal one, should be hiked further. And along with inflation over the years, that retirees' tax slab for people over 60 should be kept up fairly liberal, so that people can earn tax-free income to actually take care of their living.
What is the indexation benefit that Ms. Krishnan refers to? This is a benefit in income tax law that adjusts the purchase price of an investment to reflect the effect of inflation. Humongous though it may sound, the quantum of corpus referred to in terms of crores, tens of crores, this is the most realistic estimate that I have come across when it comes to advising on a corpus needed for retirement. What do you think? In social media, we've already seen some reactions from disbelief to denial to agreeing, saying this is a wonderful estimate and so on. We'd love to hear from you. Let us know in the comment section. And that brings us to our Did You Know section. Did you know that the first savings bank in India was established in Calcutta in 1833-34 by the government? This is according to the National Savings Institute. However, the Government Savings Bank Act was passed in 1873, and it was in 1882 that the Post Office Savings Bank of India came into existence. That brings us to the quiz question of this week. What was the rate of interest offered by the savings bank account from the bank established in 1833-34? You all probably thought we've forgotten to give you the answer for last week's quiz question. No, we have not. Here goes. The question is, why do countries aspire to be exporting giants? Why not settle for the domestic market, especially a country like India that has 1.4 billion people, and then be done with it? There are two parts to this answer. One is very obvious, right? There is a larger market to service and money to be made thereof. Why not? Let's go ahead and do it. The second is, as much as countries export, they also import. A country like India, look at medicines and crude oil. In the pharmaceutical context, the benign paracetamol that helps your pain go away or life-saving drugs, many of these may be made in India, but the ingredients that go into making these medicines are all imported. So very few countries actually accept Indian rupees to settle such transactions. They need a global currency like the US dollar. And to be able to pay in dollars, you need to be able to earn in dollars, and hence that's where exports help you. That brings us to the end of this episode. Before you go away, do not forget to like, share, and subscribe. And till we meet again, have a lovely time ahead.